Welcome to the NFO review series. I'm Rin Agarwal. In this video, I'm going to be reviewing the Edelweiss Nifty PSU Bond Plus SDL Index Fund 2026. Oh my God, funds with such big names. I find it really difficult to even remember the name of the fund, but let me decode this fund for you. This is essentially a bond fund, which means that it's buying bonds. It's buying bonds which are issued by PSUs, and these are AAA rated bonds. It is also buying state government bonds as well, which are bonds which are issued by the state governments. Now, it is creating an index based on various parameters on these particular bonds. So they change the weightages of the bonds based on various parameters, and they've created an index around it. And the biggest part of the fund is that it's a target maturity index fund, which means that it's a fund that's going to mature on a particular date, which is 30th of April 2026. This does not, however, mean that you cannot withdraw your money in between if you want to. You can very well do it. Since it's an index fund, the liquidity is going to be provided by the mutual fund. Talking about the returns from the fund, well, the post-tax return expected to the investor after indexation is going to be 5.97% per annum. What works for the fund is the fact that you have visibility of returns because you know how much return you're going to get. That's provided you hold on till maturity. Of course, it's got a very high quality portfolio with AAA rated PSU bonds and state government bonds. Again, even on the state government bonds, they would be looking at the top 10 states in that are issuing bonds. And it's low cost as well since it's an index fund. So should you invest? When you look at the 5-year space, the other options that you have is fixed deposit. You have the 5-year tax saving fixed deposit from the post office. A slightly higher maturity, you have NSE that's available. The problem with all these instruments is that the returns from these instruments are fully taxable as compared to a debt fund, which if you hold for above 3 years qualify for long-term capital gain, and due to the benefit of indexation, the post-tax returns in debt funds work out better than any of these other fixed return options. However, there are a couple of things that you need to keep in mind. First off, this 5.97% return will come to you only if you hold the fund up to maturity. If you do not hold the fund to maturity and you want to exit in between, you'll have to do at the NAV. And the NAV is going to be based on the current price, which basically moves basis the interest rates in the economy. So what I'm trying to tell you is that this fund will face interest rate risk in the interim. And so if you are looking at withdrawing in the interim, interest rate risk which is there in any other debt fund, which means that if the interest rates are moving up, the prices of the bonds fall, which means the NAV might fall. So this risk is there in all debt funds, and it will be there in this fund itself also if you try to withdraw it early. The second aspect is that currently we are in an environment where we expect interest rates to actually move up. And as I just mentioned, with interest rates moving up, bond prices tend to fall. So I don't think that it's a good idea to lock in into a 5.97% rate if we are actually expecting interest rates to move up. My take, well, go in for this fund if you're looking at a 5-year fixed return option. Although I do think that it's not a good time to invest, and my choice would always be short-term debt funds. So stay away. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, bye-bye.